Hello again. This is part 2 of the Chapter 1 overview for Accounting 2410, starting with slide 20. And as you can see, shown on this slide are the 4 financial statements that much of accounting and the rest of this course will revolve around. As indicated by its name, the balance sheet shows the company's assets, liabilities, and retained earnings, otherwise known as owner's equity, at a point in time, last day of month, quarter, or year. The income statement shows the results of operations over the period and concludes with the bottom line net income or loss. The retained earnings statement focuses on the changes in retained earnings during the period caused normally by 2 factors, net income or loss, and the payment of dividends to shareholders. The statement of cash flow shows the uses of cash for operations, financing, and investing activities for the period, along with the beginning balance of cash, the change in cash, whether positive or negative, and the ending balance of cash. Slide 21 shows a review question. Looking at this, ask yourself why the first 3 answers are incorrect. A is incorrect because assets and liabilities have nothing to do with the determination of net income. B is incorrect because, again, assets have nothing to do with the determination of net income. C is incorrect because if expenses exceed revenues, the business is in a net loss position. Therefore, D is correct because only when revenues exceed expenses can you have a net income situation. Slide 22 shows the presentation of a typical income statement and points out several key facets of the income statement. First, the income statement reports revenues and expenses over a specified period of time, unlike the balance sheet, which is a statement of financial position at a particular point in time, normally the period end. For analysis purposes, past net income provides information for predicting future net income. Of course, the more stable the business and the more of a track record it has, the more predictive past net income may be of the future. On slide 23, it shows the interrelationships between the income statement and the retained earnings statement. That is, the net income is used in the retained earnings statement to help determine the ending balance of retained earnings. In this case, it appears that this was the first year of operation, since the beginning balance of retained earnings was 0, and so the ending balance was made up of the net income less the dividends paid out to shareholders. Note again that dividends are not expenses, but rather a partial payout of current income and/or previous retained earnings to shareholders. On slide 24, as stated on the slide, part of the usefulness of the retained earnings statement is that users can assess the dividend payment practices of the business. Later on, we'll cover the concept of earnings per share, a key measure of business performance that helps analysts analyze the dividend payouts as to how conservative or liberal they may be relative to profitability. On slide 25, we're showing the balance sheet and its relationship to the retained earnings statement. The balance sheet is called that because it shows the balance between assets and the sum of liabilities and stockholders' equity. Note also that the relationship between the balance sheet and the retained earnings statement, in that the stockholders' equity shown on the balance sheet comes from the ending retained earnings balance on the retained earnings statement. Therefore, the income statement needs to be prepared first to determine net income, then the retained earnings statement to determine the ending balance of retained earnings, also referred to as stockholders' equity, and finally the balance sheet that incorporates the ending balance of stockholders' equity along with total assets and liabilities. In between the retained earnings statement and the balance sheet is the statement of cash flows, which we will discuss shortly. Slide 26, note especially on this slide the relationship between assets, liabilities, and stockholders' equity. The accounting equation, which is one of the most important things to take from this course, is expressed as assets equals liabilities plus stockholders' equity. Very important. Like any other equation, the pieces can be changed around. That is, assets minus liabilities equals stockholders' equity, or assets minus liabilities minus stockholders' equity equals 0. Notice also the format of the balance sheet. This will be important for your homework exercises and quiz and exam questions. That is, assets are to be presented first, followed by liabilities, and finally, stockholders' equity. In slide 27, we next look at the statement of cash flows and its relationship with the balance sheet. Notice that the balance of cash shown on the balance sheet comes from the ending balance of cash determined on the statement of cash flows. On slide 28, notice the format of the statement of cash flows, as it shows the cash flows, positive and negative, as they apply in each of the three key business areas: operating, financing, and investing. By showing cash receipts and payments during the period in each of these three areas, the statement provides a good look at how cash was used during the period. It also shows where the cash came from in the period, which shows users valuable information on how much came from operations, that is income related, versus proceeds from taking on debt, financing as an example. On slide 29, we have a review question. Which of the following financial statements is prepared as of a specific date? That of course is A, the balance sheet. Let's take a look at not only why A is the right answer, but why the others are wrong. Each of the other financial statements besides the balance sheet represent what happened during the period. The balance sheet is the only one that represents a point in time, that is, as of the specific date it is prepared. On slide 30, and if you refer to the text on page 41, BYP 1-9, for further discussion of how earnings management can be ethical up to a point. And I'm not going to spend a lot of time on earnings management because that's really a little bit more of an advanced topic. I think they got into it here for part of the discussion of ethics. Company management, with help from accountants, needs to determine how far they can go in managing earnings and still be ethical. In the example on this slide, the performers obviously felt the recording companies had gone too far in managing earnings to keep royalty payments below what perhaps they should have been. On slide 31, it lists the components of a publicly traded company's annual report. Besides the financial statements, there are three other required documents, and we'll discuss these in turn. Management's report, which is also referred to as Management Discussion and Analysis, or MD&A, is management's narrative explaining its financial results and providing some assurances regarding its ability to cover short-term obligations and its ability to fund current operations and potential expansions for the future. As stated on the slide, management must highlight both favorable and unfavorable trends along with significant events or uncertainties that may affect any of the factors cited. Slide 33 shows an example of MD&A for a major company. Usually MD&A are more extensive than this, and this may just be a summary excerpt. Interesting that it comes from Tootsie Roll. The next document are the notes to the financial statements. These notes explain how management makes its determinations of key balances in the financial statements. The example in the slide refers to how revenue is recognized to give the statement user some needed background on revenue recognition. This brings the revenue number more alive than a simple amount on the income statement. The notes generally indicate key accounting principles and methods used throughout the financial statements, again to give the user more clarity, more perspective on what they're seeing. Slide 35 is discussing the auditor's report. The auditor's opinion as to the fairness of the financial statements is key. It's critical for the well-being of a publicly traded company and others as well, not necessarily just publicly traded. But in terms of publicly traded, the annual report includes the auditor's report, and without that attestation by the auditor on the fair presentation of the statements, External users such as investors and creditors can't rely on what the financial statements are telling them, at least not to the extent that they would make them comfortable enough to invest or make loans to the business. Note that fair presentation does not imply 100% accuracy. The use of estimates for some accounts and minor errors that may have been overlooked are some reasons why account balances might be slightly off. By using a materiality threshold, the auditors can determine what level of error would cause the need for an adjusting entry or entries to correct errors that exceed their defined threshold. On slide 36, we have some fill in the blanks. Descriptions of significant accounting policies would be in the notes to the financial statements. An unqualified opinion would be expressed in the auditor's report. The following three items would all be part of management discussion and analysis. And finally, a certified public accountant would be the one signing off on the auditor's report. Slide 37, International Financial Reporting Standards are becoming the standard accounting standards for the international community. The U.S. is moving in this direction, although there are still some differences between IFRS and U.S. generally accepted accounting principles referred to as GAAP. On slide 38, you can see from this slide that the U.S. is moving more in the direction of IFRS and that it's loosening its requirements on foreign companies that trade shares in the U.S. to reconcile to GAAP. Slide 39, the worldwide move to IFRS is a very significant one in the world of accounting. We may consider a small extra credit exercise regarding some research you may wish to do on the current status of IFRS implementation, and we'll talk a little bit about that more later on. Slide 40 has a question, and as you can see in your text, answers A, B, and C above are all reasons why having a single set of international accounting standards would be beneficial. GAAP is not widely considered to be superior, only perhaps by some in the U.S. Slide 41 has another question. As we discussed earlier, the SOX Act determines internal control standards over financial reporting for U.S. publicly traded companies. SOX does not have any international regulatory power, nor does it have any impact on U.S. tax regulations. And finally, on slide 42, another question here. As stated in the text, IFRS is considered to be more principles-based and less rules-based than U.S. GAAP. Therefore, A is the correct answer. This then concludes part 2 of our Chapter 1 overview.